Hello and welcome to this special webinar from Fat Profits. My name's Roger Malik, your host and head of client services. And joining us today is firstly our equity analyst, Gary Burton. Gary, welcome back to the webinar. Hope you're well today.
Yes, thank you, Roger. Welcome, everyone.
Excellent. And also joining us today is our senior account manager, Edward Allen. Edward, welcome to this special webinar today.
Hello, Roger and Gary, and also to all our members joining us today.
Excellent. So the reason we're doing this webinar today is just to expand on what we discussed in yesterday's member webinar. And we've got some different topics today, including the recent reporting season in Australia, which is just finished. So we'll have a look at the corporate sector, how it's shaping up. We've also got two portfolios, some recent portfolios that we looked at from members, and we are going to share how you can relate to that portfolio yourself and what are some of the changes we have suggested and how to balance the portfolio. So you're probably going to find that quite useful, and we're also going to break down four main sectors in the market, and we're going to look at how to position your portfolio in those sectors, and we're going to go through probably 10 to 15 stocks as well. So stay tuned, and we'll get through as much as possible. But before we get into the presentation, the usual disclaimer: all our presentations from Fat Profits are general in nature. We don't provide any personal advice during these sessions, and if you're looking for that, please see your financial advisor. And also past performance is no indicator of future performance. And of course, we have a Q&A session as always. You can type your questions on your side of the screen, and we will answer those questions towards the end of the webinar. However, if we are on a particular topic and you want some clarity, you can ask it at that point as well. All right. Let's get started. First thing first is let's have a quick look at the reporting season that has just finished in Australia towards the end of last month. How did we perform? So yes, we've weathered a bit of storm over the last few months where there's been a lot of concern around inflation, rising interest rates. We've had some floods, of course, as well in our own backyard. There's tensions between China and Taiwan, and lots of other things going on around the world. But amongst all that, the important thing is to look at the corporate earnings, because that's the driver of the share market. So here's a quick glance. First thing first, if you look at the company profits, 63% of the companies have lifted their profits over the last year. 13% have cut the cash holdings. If you look at the dividends, which are obviously quite important for self-funded retirees, the dividends were actually a little bit down this time around compared to last year by 1.7%. And you can look at on the right-hand side, 61% of the companies lifted dividends, 12% maintained dividends, and 27% actually reduced the dividends, so a bit of a choppy one there. Let's look forward to break it down for you. If you look at the profits, 56% of the companies had a rise in profits, and 10% of the companies had a lift in revenue. So that's reasonably healthy, if you might argue. On the other hand, 6% cut. There was a fall in dividends by 6%. And expenses also starting to rise because we're having labor issues, supply chain issues, and that's the concern we're anticipating going forward. And this slide here shows that 92% of the companies issued a profit, 63% lifted their profit. However, there is an anomaly here because BHP, being the largest company in Australia, if you take them out, where they had a pretty solid result, the profits were up a little bit less across board, so 36.5% versus 63% if you include them. So that was a big contributor. And finally, yes, the dividends fell as we looked at earlier. Now, let's break this down in a chart format, and let's have a look at the dividend yields. Now, Gary, this chart shows us a historic performance of the ASX companies, and we're looking at, us sort of reaching the above average mark. How do you read this chart, and how can we explain this to our members?
Yeah, on the this is largely 40 years of dividend yield, average dividend yield. We can see on the extreme right-hand side, we can see the little tick down there. That's the tick down in the current reporting year, but we're above the long-term average. There's a I guess I'm trying to allay here the thought that the world is sort of going down a black hole at the moment. It's not. When we look at these dividend yield averages and we look at earnings averages, there's really nothing out of order just at the moment, and in the immediate future doesn't look to be anything out of order. So it's really just highlighting that dividend yields currently are just slightly above long-term average.
Yeah, absolutely. The long-term average is good. But the key thing to look at is also price to earnings ratios versus the earnings yield. So can you walk us through this chart?
Yeah, that's pretty much the same story. We're seeing price to earnings ratios sitting right on the average there. They're currently around about 15, a little over 15, 16% average PE ratio at the moment. This may decline if we see the market come a little lower in the next month or so. This will also decline in there, and earnings yield, of course, is sitting right on that average as well, and that may show a slight improvement if we see the share price decline. So there's really nothing out of order here. We can see the COVID spikes in there, where there was a very sharp sell-off in the markets, which recovered fairly quickly, but everything's sort of come back to the long-term average.
Okay, so we're sitting right on the average at the moment. So interesting few months ahead. And let's have a look at the charts. And this is obviously quite a busy looking chart, Gary. So you might have to provide us some detail on the ASX, please.
Yeah, these are my personal charts that I keep updated, but we can see behind all my notes and everything, we can see that the ASX is largely put in what we call a broad top over a period of during 2021. With the recent declines moving down into the third quarter 22, which third quarter's just finished. So we've seen also this current rally now really come up and retest the 7,200 point level, and we saw a very sharp decline last week. This weekly chart last week. The view at the moment is, as I mentioned in yesterday's webinar, and I mentioned it again today, there's really no distress selling in this market at the moment. There's obviously a risk off occurring, but we're seeing these sharp rallies, which is typical of bear market type activity, but we're really not seeing any distress selling amongst stocks. So there's a couple of key levels here. The 6,400, if we move down through that tentative trend line I've got drawn up through there, if we move down through there, we'll have a look at 6,400, I believe, and then potentially retest 6,200. Now, it doesn't take a lot to get there. It doesn't mean that we're going to go into some impulsive sell down. We could just see a general decline in the ASX 200 stocks of 1 to 2%, and we'll start to see these sort of numbers come up. So again, I stress that the 6,200 level is the initial breakout level. It's not unusual for markets to test initial breakout levels in their development, and at this point in time, if we start to break these levels, that would be our target.
Okay. Very good. So I think that's something to keep an eye on, because as we discussed in yesterday's webinar as well, that we think as the markets continue to absorb, and we're not bullish or bearish at the moment. So we are suggesting there will be volatility over the coming months. And as the rate rises continue to be the talk of the town, along with inflation, the likelihood of the markets pulling down is a lot further than them going up. So it's important that you adjust your portfolios accordingly. And we'll talk about certain sectors in a moment. And as we suggested recently, Angus is sitting on about 25% cash in his current portfolios, but it's still 75% in. So we are waiting for a pullback, and then we'll be going back in. Whether that's around 6,400 points or more or less, time will tell, but we will announce all this in due course as we do. But one factor, Gary, which impacts global markets is certainly the S&P 500, and this chart shows us where we are at current levels. How do you see this one?
Yeah, so this is again, sorry, my charts are so busy, but this again, I've brought out a couple of numbers here on this chart. We've been up and had a look at the resistance level again at 4,200 points about 5 weeks ago, and we've retraced off that level. And we're really the S&P 500, again, there's no distressed, we're not seeing this kind of distressed volatility in the US markets. If anybody recalls, back in 2007, 2008, we saw 1,000-point days in the Dow, that type of thing. We're not seeing that in this market. This is a fairly orderly risk-off that's occurring at the moment in the face of global events and potential inflationary cycles. So the big key level on the S&P 500 is 3,715. If we landed somewhere in there above 3,600, I think that would be a good outcome. And on the bottom of the chart, I have the relative strength in there. It just simply indicates that the relative strength currently is below the 50 level, meaning that we're in a decline until that moves back over the 50 level. So the relative strength in itself is not distressed either. It's really just languishing around the 50 level over the last pretty much this year, and so there's no distress in there as well. So relative strength is essentially a momentum indicator. So we're not seeing any great momentum moves which would swing their relative strength out to extreme limits. So everything seems to be in order, considering that we're looking at an inflationary cycle and potential quick recession.
Yeah, sure. Look, Gary, the extreme bears are actually calling out for 3,000 points on the S&P 500. I've heard a couple of them in the last few weeks, but then you've got the bulls on the other hand saying things are fine, and that would probably see a slight drop and then reversal as quickly as the rate rises peak. And the rate rises could peak in the next few months, but if they do, then we could see a reversal of this trend as well, right?
We have. I think the market has been discounted ahead of earnings in this third quarter coming up. Most of the second quarter earnings reported in the US and full financial year earnings reported in the US have been quite strong. We were talking yesterday about Bank of America reported that clients have increased their cash deposits by 4%. Cisco has also got some fairly solid sales going on in there as they change their business into a service business, but everything is all of the working parts are still in place, and I think the market might be a little bit ahead of itself. Even at these levels, we might see simply some consolidation would be the better outcome going forward into the rest of this year. So 3,715 is on the cards, absolutely. Resistance is currently 4,200.
All right, excellent. Thank you for that. We're going to break this down for you now, and looking at a few sectors, because this is important for you to understand if you're holding some commodities or financials and these type of companies. Let's have a look at each of these 4 sectors now, and we will touch on those portfolios as well to give you some sample portfolios of what you shouldn't have and how you should really adjust, give you some general guide, but we'll get to that in a moment. Let's look at the financials first, and I'm pretty sure most investors who are watching this today would have something in the financials, whether it's the banks or other financial companies. So let's have a look at the financial index first. So this is a longer term chart over the last 10 years, Gary. What does this show us currently? Are we sort of trading well above average? How do we see that?
Yeah, well, clearly over this 10-year period, the financial the Australian Financial Index, which is a summary of the banks and other financial services, including insurance companies, it's traded sideways. It's in a large consolidation zone as we've worked through very low interest rates over the last few years, as we worked through pandemics, and we saw that the index significantly drop in early 2020, which coincidentally we had a quick recession at that point in time. And then suddenly it's recovered again, and the resistance level is 7,190. Support remains at 5,320, and here we sit almost in the middle of that. And again, my observation of this, there's no stress in this. We could simply just move to the lower level and move back to the higher level over time. But the important thing is we're not seeing the stress. The Q2 2020, that was a stress point, absolutely. But it is interesting to note that the index recovered fairly quickly out of that.
Okay, so currently if we look at our position on the financial companies, and these are a few examples of the stocks we have maintained our buy ratings and we have not changed them. So this is important for you to know as an investor. As you might recall, in the recent days and weeks, we've changed a lot of our stocks from previous buy recommendation to either hold, which means no changes, or some sell halves to raise some cash. So we just want to highlight that with the financial companies, we're comfortable and we're not suggesting any changes. If you're holding these stocks, continue to hold. If you haven't got any and you're considering moving some money out of another sector, then we do encourage you to look at either of these 6 financial stocks. And just to give you as an example, if you look at one of them at NAB, we're still maintaining a buy on them. They're currently trading just under $30 a share. And look, all in all, they've actually done quite well. In fact, one of the better banks since they come out of the pandemic. Ed, maybe I'll get a little bit of feedback from you, because you speak to a lot of existing clients who've invested in a lot of financial companies. I mean, how do you see the conversation that you're having? Probably a lot of them holding the banks, and are they generally speaking happy to hold them? Or?
Yeah, look, if I go back to around June, there were a lot of concerns around that time, and it just comes down to weightings. If you're overweight banks and the banks are volatile, obviously you're going to be a bit concerned. But from my experience, most people hold banks for the dividends, and the dividends have been maintained, and that was confirmed in the most recent reporting season. NAB, as you mentioned, was one of our better performers and one of the better performers in the banking sector. I remember that capital raising back in 2020 at around $15 that was oversubscribed. So this is one banking stock that continues on a pretty steady trajectory compared to, say, Westpac, which has obviously struggled in the last couple of years. But in June, we did put a buy on that stock at under $20. So that was very good timing. But most members do ask questions on banks because most of them are overweight, especially the long-term members. I'm finding a lot of the newer members are a bit more cautious with the banking sector.
All right, good points there. So yeah, well, look, we're happy to maintain our positions in the banks. Let's move on to energy now. And before we get on to energy, this is important. If you hold anything in that space, whether it's gas, oil, or anything else, it is pretty clear, and we've made this, pretty transparent as well over time, that Europe is facing, recession fears. In fact, it's most likely that they are about to enter a recession, and partly thanks to an energy crisis. And of course, Russia is to be blamed in this regard because they've pretty much shut off all the gas to the Eurozone. And you can see the imports of natural gas here has skyrocketed this year. And that's having a huge impact on companies. So countries like Germany, for example, you can see their inflation figures have skyrocketed to nearly 38% over the last 12 months. And that's huge impact on their GDP. And this is most likely going to drive them into a recession. So Gary, having a look at both natural gas at the top here in blue and then oil here, natural gas is still holding up relatively better than oil, which has started to fall a little bit. How do we explain this to our members?
So the interesting thing about this, these two charts is back in 2008, we saw oil spike out to $140 a barrel, and natural gas at the time also moved sharply higher to about $15 at the time, US dollars at the time. Now, remembering back in 2008, we used to flare the gas. There was the gas was just a byproduct mostly of oil production. And over the period of time with development in the energy space, we've seen natural gas become a larger component of retail side of in the retail usage of heating and some electricity generation, that type of thing. And currently, I've just put a note on there that both natural gas and oil are about 40% below that 2008 high. They kind of follow each other around. And the issue, of course, in Europe at the moment is such a large use of natural gas with the Nord Stream pipeline coming through from Russia, allowed that expansion. And but currently, natural gas is really following like it has loosely over the last 10 to 12 years, has followed oil around, and we're seeing oil down around $83 a barrel today. Natural gas has come off its highs. I would expect some stabilisation in price along this area at the moment. But the hurt really is coming from the wider use of natural gas than we had back in 2008. They'll work through that. A lot of countries now are shipping gas across to Europe, and it may take a month or two to play out, but I think we'll ultimately see the prices just consolidate a little further lower.
Very good, Gary. So look, one thing we just want to highlight as well is, as not only you just mentioned, but David Lennox also mentioned recently as well, the natural gas is still expected to be reasonably strong in terms of share price, whereas oil probably will continue to consolidate. And on the back of that, if you look at the stocks we have in our portfolio, for example, and you might be holding some of these three or all of them, but we're maintaining a buy on Santos and Woodside. However, we put a hold on Whitehaven Coal for different reasons, but Santos and Woodside both have oil and gas exposure. So the oil exposure probably will consolidate for a few months. However, the gas is still expected to lift the earnings for them because the gas is still expected to remain reasonably high. So if you look at Woodside as an example, Gary, yeah, we've got in fact, apologies, we've got a buy on this, so this is saying hold, but that's a buy. But looking at the charts here, how do we see that, Gary?
Yeah, now Woodside taken the oil aspects from BHP and has performed relatively well. Woodside currently today trading around $31.90, but its dividend yield, its dividend payout over the last year has been $3 a share. The interesting thing about Woodside, we can see the price here is really in a large consolidation zone, really going back to 2015. There's nothing distressed about the chart. It'll continue to move around. Resistance remains at 39.38. With some good support around the $22 level. But one of the interesting things in Woodside's forecasts at the moment is that they expect to increase their dividend by some 37% over the next 2 years. So they've stated they're quite confident about the energy markets and where they are. And oil will do what oil does. Woodside really works off the Brent oil price rather than the WTI oil price, but they follow each other around, of course. But everything looks good cash flow. Everything looks well within the company, and the share price reflects that, still trading up around $32.
Sure, that's a good point. Look, short term, there might be some volatility. I think that's over the next few months, as we suggested. But longer term investors might just want to hold their positions. But short term, if you really want to be proactive and you want to lock in some profits, well, that's something for you to consider. But I think the recommendation remains a buy on this one. Ed, let's talk to you about Whitehaven Coal, because this has been a stellar performer. No doubt a lot of our members are holding this company, probably still holding this at the moment. we've gone back and obviously kept it as a hold. We're not buying it anymore. Of course, it would be silly to buy it around $8.50. What are your thoughts on Whitehaven?
Yeah, look, who would have thought, you know, when we first put this recommendation out last year, we had a lot of question marks, but the thematic was very clear. The coal price was moving north, the demand was moving north. We're in an energy, I wouldn't call it crisis, but crunch, yep. So we put the buy on it and maintained it, and it's just been riding that trend. It had a perfect tailwind. Just recently, a 5% rise in the coal prices just in one single session, you know, pushed this stock to around $9 a share, and there's been some profit taking recently as well. So just shows that if you get these stocks in the right trend, the cash is now coming in. The expectation of dividends is quite high. They've also initiated share buybacks. It's the old saying, you know, the trend is your friend. It's been probably one of the best performers on the ASX, and I dare say it's been our best performer in the last 12 months. But, you know, hopefully we can find a few more of these for members in the right thematic, so they can capitalize in their portfolios.
Yeah, very good. Thank you, Ed. So we'll keep that going. Now, the other commodity we'll touch on today, which we didn't talk about in yesterday's webinar, was lithium. And we've got a few members saying, can we talk about lithium? So we're going to talk about that today. So Gary, first thing first, you know, walk us through the lithium forward outlook. I mean, we all know what lithium is used for, but how are the markets looking at lithium over the next few years?
So lithium, we've got to keep in mind here that lithium is a fairly young industry. If you like, there's a lot of startups. There's a lot of money going into building production plants to supply lithium into the battery market. Now, the numbers going forward are staggering, of course, that when we start to look at lithium requirements for EV vehicles and basic battery storage, if we go to a suburb by suburb type of battery storage. So the market's very excited about that, of course, and so lithium is in immediate short supply to do that. We've seen this is based in yuan, and we've seen an immediate rally in lithium up to around 495,000 yuan per tonne. So the forward analysis on this suggests that the forward analysis, I wouldn't be fooled by this too much. It's really based on the current momentum, says that if this momentum continues, we're going to head up to very high numbers. I don't think the industry is ready for that. Those sort of numbers. I think there'll be more consolidation around this 500,000 level as more and more production comes online. And we're seeing, we'll talk about AKE in a moment. They're currently also ramping up their potential production into 900,000 tonnes, which is going to be cost that's going to weigh on their balance sheet eventually. But at the moment, everyone's very excited. There's a lot of potential in here. The market's very good at pricing in potential, but at some short time in the future, the reality will come back in and things will settle down. So if you're taking advantage of the movements at the moment, just keep in mind that this is not how it's going to look in a number of years' time.
Yeah, very good point there, Gary. Yeah, the market loves to speculate on what's ahead of us. Having said that, look, I'll take a couple of questions which have come up in a moment, but first thing first, I just want to bring up the US dollar strength, because that plays right into the commodities hands. And as we all know, the US dollar has been very strong over the last 12 months, and this is a showdown of its strength versus other currencies. So yes, the Australian dollar in the green has held up a bit better versus some of the other currencies. You look at yen right at the bottom in orange, that's really going down south. But you look at the pound and also the euro, they've come down quite heavy. In fact, the euro is now on par with the greenback, which who would have thought a couple of years ago. But nonetheless, the point we're making is US dollar being very strong of late has kept a lid on the commodity prices to a certain extent. Now, if the reversal was to happen over the coming months, which we are forecasting, then you could see a sharp reversal in commodity prices to the upside. And that means a lot of precious metals, including gold, silver, and the likes, and nearly every other commodity. So that's something to keep in mind. And if that was to happen, you will see an explosive rally over the coming months in commodities. So it's important to hold good commodities. But one question I'll take here, maybe Gary or Ed, anyone if you can answer this. So Steve asked that question earlier in the webinar saying, what do you think about me selling all my commodities and then buying back the same stocks and the number of shares in a couple of months after the expected fall by the problems in China and Europe?
Gee, that's something you'd probably want to talk to your financial advisor about. But I don't see that really. I don't know that we can forecast that accurately. That's going to happen. Commodities are, I believe, as Roger just mentioned, they're at the precipice of a potential rally over the next couple of years, based on demand returning when China gets itself sorted out, and we come out of recession. There'll be a demand again for commodities. I might be a little bit short-sighted. I think selling all. If you're uncomfortable with your positions, maybe have a look at your position sizing, but no, I'll leave it there, Roger.
Yeah, no, that's a good point. Ed, I think when we look at the portfolio in a moment, because we're going to share two portfolios of some of our recent reviews that we've done, this could be a good opportunity to explain how to have the right weightings, because selling all the commodities might not be a good idea, but
No,
look,
definitely not.
reducing some weighting and maybe just freeing up some cash for a few months down the road might be a good idea for a proactive investor.
Yeah, correct. You know, anyone that's taken on the responsibility of managing their own portfolio. You know, portfolio managers are proactive; they're not reactive. So the last thing you want to do is react on emotion, because when the markets turn on particular sectors or particular stocks, you need to be in those stocks to benefit. You know, the bears make no money in any market. So readjustment, monitoring, education, research, use all of that to make informed decisions. And that's what we do as part of a service here. But no, we never tell anyone to sell out of their entire portfolio. It's actually very rare that we've done what we've done in the short term and suggest that 25% cash holding could be an opportunity in the coming months.
Yeah, very good. Yeah, look, it's normally not the case, but this time, for the first time in a long time, where Angus is on 25% cash. But yeah, look, lightening the holdings would probably be a good idea, Stephen. So I hope that helps, but we will discuss that a bit more in detail and show you a couple of portfolios in a moment. So coming back to lithium and nickel and these sectors, so these are the stocks we're currently holding. Just to name a few, there's a few smaller ones there as well. But Allkem is certainly the best out of the lot, AKE, which has done extremely well, but some of the others not too bad. Sandfire, look, that's a bit down in copper, but copper prices keeping a lid on that, but that may turn around in the coming months. So we were maintaining buys on most of them, except Allkem, that's a hold. So talking about Allkem, Gary, I mean, this is a stock which has done extremely well from $2 to now touching in fact, over $15. So it's actually the rally that we're seeing in the short term seems to be going north. How do you see that?
Yeah, so clearly the chart shows the stock in an uptrend over a long period of time from late 2020. Breakout level at $7, and we saw a very strong movement out into break the $14.25 resistance level. So this movement is this week. The breakout has occurred yesterday and I haven't monitored the price this morning, but I would expect some sort of follow through based on that type of breakout. It's the only lithium stock that has really made this type of move today. Number of stocks, we're seeing a little bit of profit taking come in on a daily basis. We tend not to take too much notice of the daily noise around these things, other than looking at what we call a primary trend, and this is clearly in an upward primary trend. As I mentioned, the lithium sector, a lot of speculation going on around the lithium sector, including today. For example, Mineral Resources came out and said they might spin off their lithium business, and their price jumped along with that. And I think that's flowed through to the rest of the lithium producers. That there's a very positive feel about the stocks at the moment. But these types of movements are often not based on immediate income, immediate balance sheet results. So I'd be a little cautious of some of these moves. They can come in for some very quick profit taking.
Yeah, exactly right. So that's another, coming back to what we were just discussing earlier. Look, potentially you could look at, I mean, it's up to investor appetite, but some members could look at locking in some profits here, but it depends on how much weightings you have and what your forecast is. But we moved that to a hold because we're looking at it from a long-term perspective. We're happy to hold, but if you do want to be proactive, well, that's one stock you could look at potentially with some locking some profits. IGO, on the other hand, Ed, a quick look at this. This is not too far away from AKE, but we've kept a buy on this one. While it's around $14 and similar sort of trajectory, but it's a bit more volatile in the last 6 months. How do you see this one?
Yeah, there's been quite a number of windows to get in, and we have put buys on those lows. The recent low in June was just under $10. So that would have been a fantastic buy, and that's one stock that does own some lithium operations and explorations as well, and they're also benefiting from multi-commodity production and also exploration. So this is a great stock. You know, I remember when I started here, you know, more than 10 years ago, the stock was trading around $3. So this has been a great success story. So there is times to get in on this stock. You just got to be patient. Hoping there's not another sell-off, because it's just had a really good run recently, and multi-commodity, but obviously benefiting from that lithium run at the moment. So it's pushed the stock higher. But this is the company that's growing. You know, we want to hold this stock long term. It is multi-commodity, which is a benefit. I don't think they'll do anything that Mineral Resources is suggesting or speculating, because I don't think the operation is big enough. Yeah, good stock to hold for the future.
Yep, absolutely. All right, we'll move on to another sector now, property market, and that's something which will obviously, for people who either investing in properties themselves or investing in property stocks, something to watch out for. And this chart here shows the median house prices since 1970 in Australia. Clearly been one-way traffic, been going up and up and up. But yes, there has been periods of consolidation from time to time, as you'd expect. However, this time around is slightly different, because the last 10 years, we have not seen any interest rate rises at all, very low rates, and that's helping the property market. However, now that we're seeing a reverse of that, where the rates are rising and property markets are falling, maybe we'll get a quick look at how we see this. So before we look at that, Gary, may I ask, how do we see this? I know we talked about this yesterday, but some members might not have tuned in. How do we see the property market getting affected over the next 1 to 2 years?
The property market, most people ask, well, how are the banks going to fare out of this? There's a lot of discussion at the moment that the property market is way too hot. We've got pretty much the hottest property market in the world at the moment, behind Canada. And there's a lot of discussion about personal debt to GDP ratios going to affect the property sector. I think there's a little bit of a cushion in here. Ultimately, there's a bit of cushion in here because we have full employment. I think the property market will be in a little bit of trouble if we start to see our unemployment numbers tick up over the coming months or into early next year. That will be the real warning sign. We're reading in the banks at the moment that they're really not making great provisions for bad debts at this point in time. They're seeing, as I mentioned earlier, we're seeing Commonwealth Bank, we're seeing Bank of America, all their retail on average, their retail deposits are up. Commonbank's up 7%, Bank of America's up 4%. We're seeing the businesses aren't under any stress. Their business clients aren't under a great amount of stress at the moment. And I think that our property market may flatten out, of course, a little bit overheated. We're seeing that in the sales numbers come through. We're seeing auctions results back down around 55 to 60%. So there's a little bit of hesitation there. But the banks have done a terrific job in this, in their application process, where they've really not allowed people to overextend themselves to a great extent. So it comes back to the employment rate and employment numbers, and we're going through a period of wage growth now that will also help the average mortgage holder as well. I'll just go on for one moment, Roger. What's really hurting the property market at the moment is the investor side, where we're seeing the costs of holding an investment property significantly in Queensland, where they might introduce some form of property tax for interstate investors. But we're seeing the cost of rates, the cost of insurance on holiday places, that type of thing, really move up in this inflationary cycle. That is also bringing a bit of pressure onto the property market. We may see a bit of selling by investors, but I'm not sure that we'll see it in the retail area just yet.
Yeah, lots to ponder for the property investors. But look, if you're looking at investing in these companies, look, we moved a lot of these companies back to a hold. We think there'll be a period of consolidation over the next 1 year plus. So it's important to either hold your positions or you can lighten your holdings. But we expect some sort of weakness in this sector. So these are the companies we've got. And just to name one of them as an example, Vicinity Centres. Look, they're a top 50 ASX company. We've got them as a whole now. However, the medium term performance for this company has been pretty all right since the March 2020 drop. They do pay a healthy dividend. So you could, if you're holding this type of companies, look, they're still paying very healthy dividends of 5 to 6% a year, and the share price is looking okay. So you could either hold them, or if you're sitting on good profits, well, you might want to consider reducing the holdings. And
Roger, I've interrupted. I'll just add that we've recently reviewed for both Vicinity and Stockland. Both companies are in a pretty good position with their marginal increases in their leasing rates, and also their leasing books at 98, 99% in there. There's no real stress at the moment in their shopping centres and their community centres in there. So they look pretty good at the moment, having locked in interest rate rises, having locked in rent increases over the next period of 4 years. So they've got a 4-year forward look on that. So I wouldn't discount them too quickly at the moment, as they're certainly not in any stress at the moment.
Yeah, very good point. Thanks, Gary. And look, moving on to the income portfolio, Ed, this might be helpful for those investors who are looking for higher dividends at the moment. So do you want to just shed some light on this portfolio that is on the website?
Yeah, sure. It's well diversified. If you're not sure where to locate it, I get that question all the time. Just click on Australian equities on the website, scroll down. It's got its own section, latest income report, gets updated quarterly. There's an update due very shortly. It's well diversified. This is basically 22 stocks out of our 60 stock average Australian equities portfolio. There's probably another 22 stocks in there, but we've just selected these ones, and we monitor the performance, the annualized performance on these stocks. But we don't only chase 100% fully franked stocks, as you can see in the far right-hand column. The property stocks are unfranked. The advantage for someone relying on an income distribution throughout the year is that the property stocks pay half yearly and yearly, and your financials, for instance, will pay after reporting seasons. So generally, March, September, for instance, and then your other diversified financials are around that time as well. So the good thing here is that we're projecting a grossed up yield, including franking, for 2022. And if you have a look at 2023, it's quite significant. The portfolio average is going to increase to 6.6% next year. That's grossed up, and 5.4 unfranked on average. But then you've got some highlights. We all know about BHP's recent dividend, which investors are about to get paid. You know, it's an all-time record for the Australian market. So just shows you these companies are robust, they're cashed up. You know, commodity stocks should also be included in an income portfolio. We've got a couple there. In this one, property stocks are critical. You know, we've been running this for 10 years, more than 10 years, and those property stocks have been rock solid. And also the financials give you a fantastic dividend stream as well. Look, QBE has been flat for the last 12 months. The share price started around $12. It went down mid-year with the correction. It's come back. Yes, it's one of the lowest dividend payers. I get that question all the time, but it is about diversification. It's only got a 10% franking. But this model that we've put forward for members is very unique in this industry. Normally, to get this type of model, we'd have to, you know, someone would have to manage it for you and you'd have to pay a performance fee and a management fee. So this is all available as part of your subscription. It's got its own section under Australian equities. It's very clearly diversified there. You can clearly see it's well diversified right across the board. And it's been delivering fantastic returns over a very long period of time. And we do compare it to the benchmark, which is the S&P, the ASX Top 200. And you can see the numbers down there. You can clearly see that just on the net yield for 2023, you know, you got 5.4 is our portfolio average on these 22 stocks, and the ASX 200 at 4.1. So this portfolio continues to deliver.
Okay, thank you, Ed. So do check it out if you haven't looked at it. It's on the website. Now, finally, we'll have a look at a portfolio that we recently reviewed for one of the members, because we recently introduced a new product, which means you know, you can email your portfolio over to the team. The analyst will have a look at it, and we can come back to you with some recommendations. So here's a sample of, and this is the first page. There is another page, so this is quite a long portfolio. But Ed, walk us through some of the weightings and some of the adjustments in this portfolio.
Yeah, so this is an example of, I guess, a portfolio that's been held for a very long period of time. You would clearly see there on the bank stocks, for instance, and the BHPs in this one, that a dividend reinvestment plan, I believe, was actioned on this one. So in the accumulation phase towards retirement, yeah, shares were accumulating rather than taking the cash dividend. And this is what ends up happening over an extremely long period of time. You end up with a massive profit on the stock. And then obviously members can speak to their tax advisors, where, you know, some would advise that, you know, June each year you adjust the portfolio with gains and losses, so you don't end up with a massive capital gain at the end. But this is what generally happens. You end up with a slight overweighting on the stocks. We'll just go through just the ones that are highlighted, but when we do the review, we actually go through each stock and provide a second opinion and a fresh eyes review to try and help our members improve their performance. So it's giving them ideas and suggestions that they can go away and digest and consider some changes on the portfolio. Just highlighted in red a couple of negatives on the portfolio. The Bank of Queensland one has been an underperforming stock, let's face it, but the initial capital put into that stock was probably a bit too much for that size company. And Magellan Financial Group, you can see down there in the red, is a stock that we've been avoiding for a very long period of time. We made a lot of money out of this stock 5-10 years ago. I remember buying this stock at under $2. We initiated coverage and we sold it around $25, but we missed the top on it, which was over $50, and it's been declining since. So a lot of fundamental issues. The advantage here is that the allocation was actually quite good. So you can see the loss hasn't been as significant as what it could have been. There's a bit of diversification in this portfolio. You've got a couple of ETFs in there, IOO and ISO, for a bit of international diversification and index diversification which is quite good. I've highlighted the gold stocks here because gold relatively has underperformed most other sectors at the moment. But what you can clearly see here is that the diversification was quite good. Even with the losses, the weightings was quite good. I'll show you another portfolio shortly.
Well, in fact, this portfolio goes on. If you look at the second page, this portfolio goes on. So they end up actually having a lot of stocks in this portfolio over time. I think we just got a question from one of the members, Geary, saying, how long was this portfolio held for? So Ed, do you remember how long? But it seems like this portfolio was
this is a long-term portfolio. This has been accumulated over a very long period of time. So just the highlights there. Again, you've got some bank stocks, financial stocks that are overweight. Some of the larger commodity stocks, purely because profits haven't been taken, but that's the investor's choice. But you can speak to a tax advisor about that. Everyone has their own. Some people have an emotional attachment. They'd love to see these numbers grow and grow, but when the markets do correct, those numbers do fall, and they fall significantly. But medium long-term investing, if you're in it long enough, the good quality stocks always recover. The dividends keep coming in. You can clearly see there a couple of companies like Perpetual, which we don't recommend, fairly overweight on that, and a pretty deep loss there. And again, a bit of an overweight on that gold stock there, which is added to the losses. But you can clearly see the gains have outstripped the losses. So this is a very good result on this portfolio. But we also gave some suggestions on some of these other holdings, especially some of the stocks that we don't cover. So during the review, we actually go through each stock. But you can clearly see there that this is an income-producing portfolio. Profits have been held for a long period of time. But it's also a pretty well-diversified portfolio across those 4 sectors that we mentioned, financials, commodities, property and industrials, a little bit of healthcare exposure there as well. But you can see some overweightings there, like that Woolworths overexposure down the bottom there. That's obviously been held probably from the start, from the time this company floated. And that 8% overweighting is something that we generally don't recommend. And we give those suggestions during the portfolio.
Can I jump in, Ed? So a couple of things here. So one of the things we're trying to show you here is a portfolio, if it's well diversified, is good. But this portfolio, going back to the previous page, it has nearly 40 plus stocks. So we generally recommend, if you have 20 to 30 stocks in a portfolio, that's usually quite healthy. If you start getting 40, 50, 60 stocks and beyond, then it becomes a bit too much diversified. So that's one tip. But the other thing is also the weightings per stock and locking in profits from time to time, because otherwise what Ed said is, you're right. If you hold a BHP from $4 early days to now 40, it looks great with $98,000 profit, but you're reluctant to sell it in any particular year because of a high capital gains tax. So it's important to lock them in from time to time. So that's the other suggestion. But the important thing also is to lighten this portfolio. So one of the things we did was, when we looked at this members portfolio, is to suggest some reduction in weighting in a couple of those stocks, and also reducing some losing positions as well, because sometimes it's, you hold your losses for too long and they keep going down. For example, Magellan, which has just now gone into a very bad financial shape. And you can see that there now, that's starting to go down south. So that's one example, but we will have a look at another one, Ed, which looks far more balanced. So this particular
this one here is a good example. It's a younger portfolio. So it's someone that wants to accumulate positions over time. They've more evenly spread, but there is an overweight in there, and I'll explain that shortly. But they want to add to these positions over time, so that it's in the accumulation phase. Obviously, when capital is available, they'll obviously buy more stocks, and in the future they'll increase the weightings of those stocks. So this is the only problem with this portfolio that we suggested, is that you're overweight gold. You can clearly see there is an overweight of gold, and down the bottom there you'll see Nexus Minerals, which is a micro cap out of our mining portfolio, and you can see the weighting on that stock. So a lot of risk has been taken on that particular stock. So you've got to be very careful with the weightings on your micro cap, and putting that sort of capital on this particular stock. And then you look at the weighting on BHP, you probably missed out on some upside and some pretty good dividends on BHP. So because it's a younger portfolio, more risk can be taken because it's in the accumulation phase, but perhaps sometimes if it doesn't play out in your favor, you could end up with a couple of these orange spots on the portfolio, but Nexus was supposed to highlight that in orange. But it's a really well diversified portfolio. You can clearly see that every single stock in that portfolio is out of our Australian equities portfolio, with one, I believe, out of the mining. So it's well balanced right across multiple sectors. The only sector I would add to this portfolio is probably a bit of healthcare, and that's probably missing, but that could be adjusted over time. So this is one of the better portfolios because, apart from the gold overweight, is that when the markets move and your weightings are fairly narrow and spread wide, your movements in the portfolio are quite small, and it takes the emotion away. So this is a pretty good portfolio. So we went through it obviously more in depth as we reviewed it, but this is a pretty good portfolio going forward.
You're right, Ed. Yeah, so this is that's all the stocks in this portfolio. So that's a lot. It's not too diversified, and you're right. Other than the Nexus high risk that they've taken, unless they know something that we don't, then you definitely look at BHP, only $4,000 in there versus Nexus sitting on 16,000. So that's probably the other way around. But other than that, that's a healthier looking portfolio. So one of the things we were proposing here today is we're just about coming up to 22 years in a couple of weeks. So that's a milestone for us. As part of that celebration, we're offering an opportunity for our existing members who are watching this today, that we've got two options available for you. We can either offer you some loyalty rewards, which means you can extend your service out by another X amount of time at a reduced rate, which is part of this promotion that we're offering you. So if you've got a few months left on your account or not as much, you can extend your service, or we have another option where we can add the portfolio reviews to your account, so you can upgrade to portfolio reviews, and you can email those through, and then we can discuss that and provide you, especially in these tricky markets at the moment. If your weighting is out of whack, or you want to look at being a bit more proactive, this might be a good time for you to get some second opinions and some second set of eyes, some fresh ideas, and that might be coming to fruition probably over the next 1 to 2 years as the markets change and then go back into a bull market. So Ed, do you want to just explain, and I'll put up an opportunity here. So we're offering up to 50% off for our members to take advantage of those. So do you want to just add a couple of points, and I'll put up a registration?
Sure. Look, obviously the advantage of our service is that you're not buying and selling through us. You don't have a stockbroker calling you, asking you to make changes to your portfolio every couple of weeks. We provide you with what we believe is the best advice throughout the year for you to make your own purchases, your own adjustments in your own portfolio. But we're always here to help. So for members that want to get a bit more out of our service, these reviews that myself and Roger have been providing lately have been upgrades to some of our longer term members who've really appreciated the review and the suggestions. It's a fresh eyes approach. It's a second opinion. It's all about it helping you improve your performance, your weightings and diversification. And members have come out of it with they're telling us that they feel a bit more balanced, a bit more comfortable going into the next period. So it just removes all that guessing work and the gut feeling that a lot of investors make that don't follow research. So there's a poll there. If you want to discuss it with us, we're happy to have a chat. We can offer you a discount on your membership. We can also add the portfolio review option. We give it to you in writing as an entitlement on your membership. You can action that any time. You don't have to have it straight away, but you can have that up your sleeve. And for the longer term memberships, we can provide an annual portfolio review. If you want to discuss it, we'll provide more information. Just click that option as well. But we're always here to help. If you're going to be managing your portfolio for the next, I don't know, 1 to 5 to 10 to 20 years, I have members in their 90s who are quite optimistic, and they tell us they're going to be in it for a couple more years, and I sort of shake my head and ask them if they're still buying green bananas. But it's a tricky one.
We're getting a couple of questions. I'll take one. This is from Jenny. She's saying, I actually have one of those type of portfolios. I've been buying and buying, haven't really sold too much, so I resonate with the first portfolio, and I'm interested in that. So she's asking what sort of pricing we're looking at. So just to answer that, I might answer that for you, Jenny. Look, pricing is actually very flexible in the sense that it depends on case-by-case scenario and how long you want to go for, and how long you've been a member with us as well. So we take your loyalty into account. So if you've been a member with us for, say, 10 years plus, then we'll take that into consideration versus a new member who's just joined maybe a few months ago. So that will have a bit of bearing to your package that we offer. But we'll look after you. These are usually tax deductions as well. So we will issue invoices with all the entitlements there, and it should be pretty nominal for most of our members.
Yeah, and basically, if somebody wants to go with the portfolio review option, it's a very simple process. You just email us your portfolio. I always ask my members for just a day and time that I can contact you. You'll have your notepad ready, and we'll go through each stock and we'll provide an opinion, a recommendation, but we'll review it first before we call you with an analyst. And then we'll go and conduct the review with you one-on-one. So it's very beneficial. We also suggest some stocks that will add some diversification and add a bit of variety to the portfolio. So probably areas that you're missing out on. So again, they are very beneficial, and it's something that we haven't really done since 2016, Roger. So
yeah.
That was the last time I believe we were offering portfolio reviews as part of an entitlement with a membership.
Yeah.
So it's based on the performance of the market this year, and we believe it's a good time to offer it for our members.
All right, we'll close this now. In fact, thank you, members. In fact, we're getting a lot of responses, especially in the portfolio review section. In fact, out of everyone who's selected the options, we got 71% interested in the portfolio review. So it looks like we're going to have quite a few of those coming through. Because look, we don't blame every investor at the moment, because a second opinion would help, and that's something we're happy to conduct. So I'll close this now. What we'll do is we'll take a few questions which came up earlier, and we'll wrap up the webinar today. In fact, we're getting some comments as well from a few members saying good webinar. This is from Jim as well, saying Gary, well done as well. So I'll take Jim's question first. He's saying, do the agri stocks, for example, New Farm, Elders, do they fit into the commodities sector? Because they're acting a little bit strange at the moment, with New Farm up 7% yesterday and another 4 or 5% up today. So Gary, maybe over to you. Do we classify them into the commodities?
No, not really. They're really probably a little bit of a sector on their own. We did review Elders just a few weeks ago. We're a little hold a view over this agricultural sector. Around the prospect or the risk of foot and mouth disease at the moment. We think that Elders is pretty much fully priced where it is. It's going to be very difficult for them to gain further earnings out of the out of the agricultural sector based on the rising prices of fertilizer and cattle. Eastern cattle auctions are now declining. The auction price is now declining. So we take the view that Elders is fairly fully priced. A New Farm will also have the same issues with fertilizers and across the farm sector. So not only are they dealing with their supply issues, we've also got the farmer on the land also dealing with their own issues of inflationary products. We're seeing the cost of capital equipment, of course, is increasing. The capital equipment providers have to put their prices up now because of there's a long delay. They have to anticipate what the future prices of parts will be because there's a long delay between sourcing their components and actually getting something out of the factory door. So there's a price to pay there. But they're very much a hold at this stage. They're not a sell or sell half, but very much a hold.
Yeah, very good. In fact, the comment, I'm just reading it now, it's from Jim earlier, was saying kudos to Gary and welcome. A great webinars yesterday and today. his contributions very welcome. Keep up the good work, guys. So thank you, Jim. We appreciate your feedback. The question on agricultural stock, we got a similar question from Glenn. I think you answered most of that question, but I'll ask just in case. So Glenn says, with livestock prices maintaining strength and crops looking promising, how should this reflect on New Farm and IPL results?
Yeah, one of the issues that came up yesterday, Dave Lennox mentioned that the Ukraine is now getting grain out, and we're starting to see the prices of grain and corn, wheat really turn a little lower and start to consolidate at lower levels. So we're starting, the market itself is essentially calming down, if you like, in this area. So it's really going to now depend on the weather systems. We've got a wet weather forecast coming up for this summer and into next year from the bureaus. So we're expecting a relatively strong wheat crop. Cattle will remain well watered in there, but that of course that brings a lot more product to the market, and we see prices remain steady or decline because of that. So I don't know that we're going to see any great shortages out of these areas that would force prices up any higher than they are. The sectors are dealing with their own inflationary issues, and of course we're still seeing a lot of pressure on fruit pickers, lack of fruit pickers in the outback to bring in the fruit crops, which the government's dealing with this immigration program, hopefully, which may make some improvement. But we think everything is pretty much fully priced at the moment.
Yeah, okay, very good. We've got another question from Carlo saying, hi gentlemen, I missed most of the webinar, came in probably late. Can we get a recording of this? Yes, Carlo, we will provide a recording to all members probably on Monday or over the weekend. So yeah, that'll be emailed out, so that's fine, not a problem. Another question, in fact, a comment came from Lou saying, great webinar. Thank you, Lou, appreciate that. We do provide as much information as we can to help our members. Another question, Ed, maybe you can answer this one from Karen saying, is the portfolio review a once only?
Look, generally it's an entitlement on the membership, and we also put it on the invoice as well. So generally for the shorter term memberships, yes, it's a one-off. But if you commit to a longer term membership, we'll put a portfolio entitlement, because it's not something we're going to do ongoing, Rog, as you know. It's something that we did around the reporting season. We don't have the resources to be doing these every day, so we're doing them now in the current quarter. But we can put it as a annual portfolio review if that's what the member requests, and that way, you know, once a year or whenever they feel like they need a review, they can send it in. But I believe it's only myself and you, Roger, that will be conducting these reviews.
Yeah, that's fine. So just let us know. And look, finally, if you do have any questions or you want to discuss these opportunities, you can email members@fatprofits.com.au and we can get back in touch. But I think for all the members who've shown interest today, the next step is we will get back in touch with you over the coming days, and then we'll discuss this one-on-one, and we'll try and work out something which can add some value to your existing service. So look, on that note, my name's Roger. Thank you for your time today on a Friday. We wish you all the best for the weekend ahead, and we'll catch you once again next week. In the meantime, all the best in the markets. I'll pass it on to Gary first to say his final words. Gary, thank you for your input. It seems like your information is being received well by the members.
All right, thank you, Roger. Thank you, everyone, and we'll talk to you soon.
Okay, and Edward?
Yeah, thank you. Looking forward to talk to some of our members that are interested in having a chat. Always here to help, and enjoy the rest of your day. Have a great day.
Okay, bye-bye.